Let's talk economy. India's macro growth data has become confusing. The first quarter GDP number at 13.5% came in below the Reserve Bank projection of 16.2%. It also showed a very measly 3.8% growth over the pre-COVID first quarter, that is the FY20 Q1 level. The first quarter number led many economists to cut this year's GDP forecast to 7% and even below 7%. Yet, all the recent August data are looking strong. PMI, Purchasing Managers Index, for manufacturing is at 56.2, a very strong number. GST collections at 1.44 lakh crore, also strong. And auto sales from Bajaj Auto to Maruti to M&M are showing very strong domestic growth. To discuss the long and short of these growth numbers, I have with me an eminent economist, Santanu Sengupta, Chief Economist, Goldman Sachs, India. Shantanu, good morning and thank you very much indeed for joining me. First things first, Q1 macro data. There was a string of GDP downgrades by several economists. What's your analysis?
Right, so thanks, Lata. Look, the GDP numbers on the domestic private demand side, which is private consumption and investment growth, that came in strong and that came in line with our expectations. Again, much in line with the high frequency indicators, some of them you mentioned now for this quarter, but much in line with the high frequency indicators that you saw in the previous quarter. So private consumption growth at almost 26%, investment growth at 20%. We were expecting about 25 and 18 for each of these. That came in line with expectations. The issue was that you had a net export drag, which was higher, and also the government expenditure that we were anticipating that came in lower than our expectations, especially on the real basis. And hence you had nominal GDP growth almost at 27%, and yet real GDP growth at 13.5%. On the back of this, we were at 7.6% growth for the calendar year 22. We have cut that to 7% now. For the fiscal year 23, we were at 7.2. We have cut that to 7% now. So we are at 7% growth for both the calendar year 22 as well as the fiscal year FY23. Okay,
let me take the stronger strands that you referred to. Private final consumption coming in a good 26% higher year on year. And I was also doing the trend analysis from 3 years ago. Even there, it is up 10%, which is, okay, decent considering the bad year we had. But, the more recent data, PMI in August, auto sales, I mean, everyone, Maruti, M&M, Bajaj Auto, Enfield, Royal Enfield, all of them have shown very strong domestic growth. So you don't think that we can make up what we lost in Q1?
No, absolutely. So again, the right way to think about this is in sequential terms, right? So in sequential terms, in Q1, you contracted 9.6% quarter over quarter. Now compare that with any time, the 20 years before the pandemic. So the pandemic was, you faced the first wave and then the Delta wave. So you had a lot of contraction because the economy suddenly stopped during those quarters. But if you leave that aside, in the previous 20 years, you contracted on average by about 4.3%. And this time around, even while the economy was relatively open, you contracted by 9.6%, right? So we think that sequentially some of this growth will come back. And hence, the second half will not look as bad as what we were anticipating. So we were anticipating earlier that all the reopening boost will come in Q1 and then, it'll taper off. But now we think that, since Q1 has contracted so much, you will get some of this boost back in the next couple of quarters. So I think one of them would be clearly government expenditure, right? The fiscal data came out for July as well, and we posted a fiscal surplus on central government's books, which would mean that expenditure will come back later in the year, either in the form of some subsidy spending or something that the government is extremely focused on, and the finance secretary also alluded to it, which is the capital expenditure growth, which again should be good for investments going forward.
Fair enough. And no, I take your point about this domestic sales, and let me see if we can run that data also. If you looked at all the auto sales numbers that were, I'm just taking the autos as an example, domestic sales very strong. Look at Bajaj Auto, 49% up domestic sales. Exports down 28%. I could go on like that. Even in Maruti, domestic sales up 30%. Exports, okay, up barely 4%. Further down, TVS, domestic sales up 15%. Exports down 15%. So, what we may get in domestic sales will we lose in exports? And therefore, does GDP get a backlash from global slowdown?
So you will have some of these headwinds as you head into the second half of the year. So clearly there's going to be, even on the domestic front, there is going to be further financial conditions tightening that's going to come through from rates tightening by the RBI. Secondly, on the external side, there's going to be slower global growth. There is going to be a net export drag that is going to feed into numbers. But I would say that that's already baked in. Sequentially, though, if you have contracted this much in Q1, there is some of the rebound, especially from the government side, that we will expect into the later half of the year. In any case, on the external front, our view remains that the current account deficit will be about 3.3% of GDP this year, and it will remain at that level into next year as well, because our commodity forecasts are still quite elevated. So into Q4, which is 3Q FY23, we think that oil prices will rise as the supply constraints really show up.
Okay. I was going to come to the CAD in just a bit, but let me take that since you raised that issue. How does this work up on the rupee? If you're going to have a 3.3 or a 3% plus for 2 consecutive years, as you see it, then you continue to see pressure because the rupee's come back. It's been an outperformer among EM currencies, even in fact among global currencies. You see that pressure, adding up and goes above 80, 81 rupee?
So our forecasts on the rupee are, we see 81 in about 3 months' time, and in the 6 to 12 month period, we see 82. But despite that, we think that the worst in terms of the rupee's depreciation is behind us, right? So you made the move from 76, half 77 to 80 now, and you've lost quite a bit of reserves along the way. From here on, you remember also during this time, equities saw outflows. Going forward, what you should see is some of these flows come back, and the worst in terms of the balance of payments, which is ultimately what the rupee should be in this year, whereas the next year should be slightly better. You'll still have negative balance of payments, balance of payment deficit, so there will be a reserve drawdown, but that should be better than what you're seeing this year. Just in terms of numbers, we're looking at about $60 to $65 billion of a balance of payment deficit this year versus about $35 billion of balance of payment deficit next year. But on the path, we remain of the view that the rupee will go to about 81 in 3 months' time and 82 in the 6 to 12 month period. Okay,
got that. So there is a near-term pressure, but that may alleviate next year for the currency. Let me come to inflation, since you touched on the fact that Indian financial conditions will also tighten. Asia is behaving very differently this time. I'm not saying anything new. China is actually cutting rates. Korea, last inflation number was reasonably benign compared to the month ago. And so is India's inflation. For 4 months in a row, it's peaked off and it's, getting subdued. Do you think India will have to be in step with the Fed tightening?
Right. So on the inflation front, there are, again, 2 parts, right? So if you look under the hood, you'll find that food inflation has surprised most analysts on the lower side. Whereas core inflation, actually, we look at core from a ex-petrol, diesel, gold, and silver perspective, because all of that is exogenous to the system, that has kept creeping higher. Our sense is that in this quarter, inflation will, on a headline basis, will peak out and will start going lower. But our call also is that core inflation remains elevated in the 6% plus zone for the next couple of quarters. The other 2 points to consider are that, remember, again, from the GDP numbers, your domestic private demand is fairly strong. It's showing up from your consumption and your investment data, right?
That's right.
If you think about, again, a rate formulation in an emerging market like India, and you think about output gaps, you would think about the output gaps from the domestic demand perspective, right? And I would imagine that that is pretty strong, and that's closing fast or is slightly above potential. The second is with the Fed now indicating, especially from the Jackson Hole comments, now indicating that they will be relatively more hawkish than what the market was earlier expecting. EM central banks will have to move, maybe not exactly in line, but at least they will have to move in the same direction. Our call remains, therefore, that the RBI will keep moving. They'll slow down the pace of hikes to 35 basis points in the next policy, that is the end September policy, and then 25 in the December policy. You get to 6% by the end of the year. Then you have more degrees of freedom to think about the world, right? Where are commodity prices? How is global growth doing, and so forth. Our call remains that we will have an extended period of elevated Fed funds rate, and hence the RBI will have to move 75 basis points further next year, and hence our terminal rate call of 675.
675?
In 2023.
Okay, you
right.
I think are a bit of an outlier, but the outliers could be absolutely spot on. People have gone up to 6.25. I haven't heard too many beyond that. But yes, given your estimate of crude, I'm not surprised at all. And as you pointed out, output gap is closing. The Reserve Bank governor said in his speech, right, that capacity utilization is running at 75% or 75.3, which is higher than the 10-year average. So, yeah, that stacks up. I agree with you. But Santanu, you spoke about very strong demand. Urban wages, they looked very good in the first quarter. But already we are seeing IT companies saying that they're cancelling variable pay. So urban wages may have peaked off. I don't know. I want to know your opinion. And rural wages have not even picked up. Rural wages are pathetic. They've been falling. That's the 3-year trend. MNREGS demand is continuing to be higher than pre-COVID levels. So are you that strong of are you that sure of domestic demand?
So the right way of looking at this is, again, the way we look at it is through the price pressures, right? So if you look at core inflation and you break it down into core goods versus core services, much like the rest of the world throughout the pandemic period, core goods is what was elevated, right? So it went up from about 3.5% year over year to about 7.5% now. Our sense is that as commodity prices peak out, this will stay elevated for a while and then start coming down. But remember, core services inflation throughout the pandemic period was in the region of about 4.5% to 5%.
Yeah.
Right? That will definitely start going higher as your output gaps close, right? So as you went through 2 very sharp dips in the first wave and the second wave. And from there on, as your output gaps close, the core services inflation will start moving higher. That is what keeps core inflation elevated. The domestic demand output gap closes, commodity prices slightly elevated, and the Fed sounding relatively more hawkish than what expectations were earlier is making us believe that, from 6% by the end of the year, the RBI might have to move more in 2023 as well.
Okay, fair enough. Yeah, one can see that in the Indian hotels price itself, the way services consumption has gone up. Shantanu, I want to end with your view on the Fed backdrop, the global monetary and financial backdrop. What is the Goldman Sachs thinking? We are going to have this jobs data and then CPI from the US. As well, the second half, the Fed is going to even do a double its monetary tightening from about 47 billion that they were drawing back in the first half. Second half, they're going to draw back 95 billion. So what's the global backdrop? Are you continuing, FII flows turned positive. Can we expect them to continue in the second half?
So on the Fed, our call remains that we'll have 50 basis points of further tightening in the next policy from the Fed, and then 25 each in November and December. Now, with the Jackson Hole comments, the risks on these are skewed to the upside. The payroll data will be an important determinant in terms of where the Fed funds rate ultimately are. Our call is that of 350K, about 50K above consensus. So that's the background on which, we are thinking about monetary policy in India. In terms of other central
More
bank
specifically,
backdrop, it's been relatively hawkish. While inflation is peaking out in certain parts of the world, the Fed has now, Powell has very clearly put out now that you'll have a elongated period of restrictive monetary policy, which is different from what the thinking was earlier, that you'll have a turn in the Fed cycle sometime in 2023. So a turning Fed cycle versus an elevated and Fed cycle staying at the same levels in 2023 is a very different backdrop for emerging markets. And therefore, we think that the RBI tightening continues.
No, but the specific point I wanted was about flows. To your elevated, elongated tightening, if you also add the fact that there is going to be, drawback of liquidity by the Fed, these FPI flows are very big for us, for the market, and for BOP, and for the currency. Does that continue? What's your best guess?
So on the flows front, obviously there are two questions, right? One is what is happening to global liquidity. Second is where are Indian valuations compared to its own history versus other emerging markets, the comparable emerging markets. And finally, what's the question on the currency, right? So the question on the currency has been relatively solved now because you've had a little bit of currency depreciation, and therefore FIIs find it a more attractive entry point now versus earlier. And therefore, we think that some of these flows come back in the back end of the year and in 2023 as well, which is the reason why we think that balance of payment deficit will be relatively lesser in the next year than what we are projecting in 2022.
Okay. All right. That was very useful. Thank you very much, Santanu Sengupta, for joining us and for speaking on a range of topics. We wind down on Bazaar on the note that all the markets are flat. Rupee, equities, as well as bonds. Everyone waiting, of course, for the big payroll number from the US on Friday evening. Thanks for watching Bazaar. Chartbusters up next.